So in terms of today's presentation, it's really to guide what we're thinking about the global outlook. And it's going to be about 15 minutes, and we'll go through the top of mind themes, which includes what the central banks, especially in the developed world, has been doing in terms of the more hawkish pivot, and what we think that means for recession expectations, global growth, and how that matters for overall asset allocation decisions. So let's get started and go to the next slide. So typically before I delve into any presentation about the global outlook, I like to set the stage by reviewing what has actually happened in markets on a year-to-date basis. And I'm sure all of us have been feeling that as well. So if I could focus your attention on the third column from the right-hand side, you can see that nominal cash returns are at the top of the column in the quote chart. So unfortunately, this really highlights that it continues to be quite a challenging environment for investors. And also what had really stood out to me was how developed market equities as well as global bonds are both registering double-digit losses. So this also shows how difficult it is for investors like us to rely on traditional diversifiers. And then amongst risk assets, Asia ex-Japan, our region, has actually held up relatively well. So far, it has outperformed developed world equities by 400 basis points or so. So if there's anything that is certain, I would say is that volatility is here to stay. And it is kind of tempting for investors to liquidate investments and go to cash in this environment. But I wanted to also highlight that if investors were to back out the high levels of inflation that we're seeing in the US today, which is 8.5% to 8.6%, your return on real cash would still be quite negative. So in our opinion, there are other strategies that investors can consider amidst this already very negative sentiment that we're seeing in markets today that's already priced into various risk assets that will help to present a better risk reward profile for investments on a go forward basis. So on the next slide, we've all seen in the news what's happened. The month of June has really started to show that there is a more hawkish tilt from developed market central banks, most notably being the Fed, who delivered a 75 basis points rate hike at the June FOMC meeting. Then some other notable ones are the Swiss National Bank, which raised its policy rate by 50 basis points for the first time since 2007. And then we also have the Bank of England and the European Central Bank also continuing to reiterate that they would act forcefully in response to inflationary pressures that they are seeing at the moment. So on the next slide, this really explains why they have become a lot more hawkish. This is really because the developed market central banks have lost patience in their fight against inflation, which has really hit multi-decade highs. As you can see on the right-hand side of the page, where a lot of the numbers that we're seeing in the developed markets for inflation at the headline level is very red, meaning that they are very high. So zooming in on the US headline inflation was 8.5% or so, the latest reading. That was above consensus expectations for a decline. But if we look a little closer at the details, it's the same few culprits. It's energy, it's food inflation. And why are they high? It's because of continued supply side issues that has really been worsened by the Russia-Ukraine conflict, which has been ongoing for way too long. The US consumer is still relatively strong, so they have continued to buy a lot of new vehicles and used vehicles, which has caused some inflation in that space as well, even though the year-over-year numbers have been coming down. And then if we think about reopening linked inflation, and I'm sure all of us have been experiencing this as well, trying to book an air ticket now is so much more expensive than it was in the past. So, all of these things in combination has led to these high inflation numbers that we're seeing today. But that's at a headline level. And, we think that these forces should normalize over time. And if we do look at a more stable measure of core inflation, which strips out all of these different components, it actually is around 6%, and it continued to moderate lower on a year-over-year basis, which is led by core goods. And yesterday we also had the PCE inflation numbers, which is the Fed's preferred measure of inflation. It also came in a little bit lower than expected, 6.3% year over year at the headline level and 4.7% at the core level. So I think it's positive in the sense that there are signs of easing on the core inflation front. The other thing that I would like to also point out on this slide, since we're here, is that inflation is picking up in Asia, but it is nowhere near what the developed markets are experiencing, primarily due to a couple of reasons. One of the reasons as to why is our economies have really only started to reopen and recover, and our governments didn't spend as much money from a fiscal perspective trying to boost demand. And as such, if you look at the output gaps of a lot of our economies, they're still below potential. But the risks are really that food and energy inflation continues to hurt a little bit more because the weights of these food and energy is a little bit higher in Asian economies versus that of developed markets. So what this means is that if food and energy inflation continues to be very high, that could impact Asian economies a little bit more. So that's the risk there. So going on to the next page. So what does all these actually mean for the rates markets? So at JP Morgan, our expectations are for the federal funds rate to rise between 325 basis points to 350 basis points by the end of this year, which basically means 75 basis points, 50 basis points, 25 and 25 basis points rate hikes for the rest of this year. So this is in line with what the Fed has guided the Fed funds rate to be at the end of 2022. And if you look on the right-hand side, what's the good news? The good news is that there is a good amount of runway that is being laid out by the markets, and central banks are very unlikely to be able to tighten above market expectations, given that if you look at the gray line, which reflects market expectations for the Fed funds rate at the end of 2022, it's already at 3.5%. So given that the market already expects an aggressive Fed, and while the next CPI print will still be the determining factor and push expectations either one way or the other, the path forward for the Fed definitely looks a lot more aggressive now than it was 3 to 6 months ago. So given what we do know about them, the Fed, making it so clear that they are prioritizing inflation and will act aggressively to contain it, raises our expectations from a recession standpoint and how quickly that can actually come. So on the next page, to address the fact that how quickly can recession come, we're already starting to see some of these forces hurting growth in the US. So we do have higher rates and we do have tighter financial conditions. So we're starting to see some pain points in the economic data. So on the left-hand side, the growth has been downgraded for a lot of major economies, including the US, since the start of this year. So the diamonds actually show you where the growth expectations were at the beginning of this year, and then the bars, they show you where they are now. And most of it has been, move lower. And then on the right-hand side, the reason why is over here, where we track economic surprises, which have really been on a downtrend. And some of the notable mentions that I would point out include things like initial jobless claims rolling over. We have the 30-year fixed rate mortgages at historical highs since 2008. It's really affecting the US housing market, especially for people who are still looking for housing. And then also the consumer, which has really been the fundamental strength of this US growth story, is starting to use more credit, even though they're still healthy. So they are increasingly relying slightly more on credit to buy their daily necessities because of the high inflation. So this is another thing that we have to continue to consider and think about when we think about what cracks could form in the consumer strength story. So on the next slide, so I think so far what I've gone through is that the US economy, which is the biggest in the world, is expected to slow. The Fed has lost patience with inflation. So we acknowledge that recession risks have risen, even though things still look okay for now, but it doesn't mean that things cannot change rapidly. In the worst case scenario, we can find ourselves in a recession sooner rather than later. So on the next page, instead of just hoping for the best and thinking that we can avoid a recession, I think what we should be focused on right now is to think about how a recession can actually look like if we do actually see one. So on this slide, it's very busy, but the concept is very simple. Over here, we looked back at past recessions as a guide all the way back to 1940s for the US. And you can see that on the third column from the left-hand side, that we rarely had very severe recessions in the US. Then focusing on the second to last row of the table, the last recession was particularly severe because of how badly the consumer was hit. because of the nature of the recession, which was unexpected, and it caused all of these shutdowns, and the consumer couldn't go out and spend because unemployment basically hit. But typically in a recession, it is the private investment component, which is the sixth column from the left-hand side, that really hurts the US economy, and the consumer have actually been quite resilient throughout all of these different recessions. And it's helpful to know that, because consumer is actually two-thirds of the US economy. So, on the next page, something else that we are watching very closely is also potential vulnerabilities in the US. So all of these details some key ratios that we are tracking very closely across different parts of the economy that are very important to overall growth. So if we start with banks, they're in a relatively healthy shape. The corporate sector has also very strong debt servicing ability, even though they have high debt to GDP ratios. If you look at the households, the savings rates are still quite high, even though they've been gradually taking that down as they spend more and more money on things like daily necessities, as well as discretionary spending, as the economy has started to reopen globally. And then if you look at high home prices, that's slightly concerning, but we don't think it's going to be anywhere close to what we saw in 2008, which was the housing crisis, because the whole structure of the housing market has changed so significantly since then, and it's become so much stronger in terms of fundamentals. And then labor market, that's one that's a little confounding, because it clearly shows that it's overheating, but it's also a good thing, because if you have high wages and high employment, this helps the consumer to keep spending. So all in all, if you look at this entire chart, I don't think there are a lot of excesses or imbalances to unwind this time. So we do think that even if we unfortunately see a recession this time, it will be a much shallower one, and that would hopefully be enough to really tip the Fed back into a much more accommodative stance than the stance that they are advocating for right now. So on the next slide, what do we do with this outlook? So over here, we put together a couple of very key macroeconomic indicators, some of which were included on the last page as well. And this helps us to think about where are we in the cycle. So we are moving, really much to the later part of the cycle. Hopefully we are able to avoid a contraction, but even if we do not, if we can use history as a guide, the table in the second half of the page below should give us a pretty decent idea on how these different asset classes can perform across these different macroeconomic regimes. So you can see that in late cycle, on average, equities can still generate positive returns. You look over to the right-hand side, even though credit spread exposures, they typically are a little lower in terms of absolute return. What we think is really helpful in credit spread exposure is that the duration component of returns can actually act as a diversifier if we do really progress from a late cycle condition to a contraction. And this help investors to actually get some income while they are waiting to see how this situation plays out, instead of having really negative cash or negative returns on their cash. And this will help the overall risk-adjusted return at the portfolio level to be more positive. And lastly, something that I would point out here that's interesting as well is that if we do go into contraction, historically, this analysis shows the benefit of investing in Chinese or Asia ex-Japan equities more broadly, because China tends to have its own economic cycle. And hence, historically, even when the US hits a speed bump in terms of its growth outlook, the Chinese equity market can behave quite differently, because China is on its own cycle. So this really points to the fact that Chinese assets can have pretty good diversification properties to an overall multi-asset or just even developed market equity allocation. So on the next page, so given that we are progressing to later stages of the cycle, or maybe even a contraction, I think what we should really be doing here is to look at increasing allocation to fixed income, to really prepare for this slower growth environment over the next 12 months. So, from that perspective, we are shifting from more of a pro-risk environment towards a more balanced or maybe even more conservative position when it comes to asset allocation. So from a valuation perspective, which is what this slide is trying to show, it it shows that things are starting to look attractive again, both in credit as well as in rates. If you recall, one of the market expectations chart that I had shown earlier in terms of rate hike pricing. So over here, we do like US high yield, and we continue to expect that the default environment will remain quite benign. And in addition to that, the US high yield market also doesn't have a lot of refinancing due over the next 2-3 years or so. So, from that aspect, we don't think that there's going to be a lot of stress from companies to, really urgently try to refinance their debt. And also corporate cash balances are at all-time highs. So they should be able to, pay back their interest payments should at each, coupon payment. So what this really does is also to help diversify the overall multi-asset allocation, and adding things like core fixed income in the US investment grade space, which has also cheapened, also have a place in portfolios despite their longer duration exposure. Because if we really do have a bad outcome in the economy, the duration component in US investment grade can help to offset the spread widening that we can possibly see from these levels. So on the next page, besides this better entry point that I've just shown on either US rates or income producing instruments like US high yield and US investment grade, as we navigate this uncertainty, we think there also exists an opportunity in Asia ex Japan, as the outlook here really brightens more significantly compared to what we had over the past 2 years. So moving forward, on one slide. So obviously with Asia ex Japan, we have to focus on China first, because China is the biggest part of Asia ex Japan equities. Over here, we do believe that the worst is behind us in terms of COVID lockdowns and very harsh regulatory policies. If we look at the high frequency mobility measures, they've really improved significantly. We have subway flows, freight flows in Shanghai, Beijing, close to 70% of pre-lockdown levels. A lot of our coworkers are now, going back to the office as offices have really reopened. And then government is also really promoting a more sustainable solution to this situation by promoting vaccinations. And Beijing government has actually offered 1,500 RMB for people to take their boosters, and that's not a small amount of money. And all this time, they're also developing an mRNA vaccine, which should really help in terms of overall efficacy in containing the virus. So and they're also really relying on mass PCR testing to really manage the situation at the moment, such that they can still have some form of economic activity and not really have a major drag on their overall economy. At the same time, they're also protecting lives and preventing the spread of the virus. So, with this very holistic approach that has progressed very quickly, on the right-hand side chart, you can see that the high-frequency economic data has rebounded very nicely, which is, on the manufacturing and the services side as well. So PMI, you can see, has rebounded quite well in going from April to May. And as well as not on this chart, the latest numbers that came in from May to June also showed that manufacturing improved even more, and it's now above the 50 line, which indicates a expansionary growth environment for the manufacturing space. So, overall, I think there has been very good progress. Activity still remains weak, but the policy has really turned to become so much more accommodative and targeted since mid-May, and we take that as a very good sign for China. So on the next page over here, this is something that we track very closely, credit conditions, and you can see that they have been improving very quickly after the government actually took a series of action to actually ease credit conditions. So some notable mentions include reducing the lower bound of the mortgage interest rate by 20 basis points for first-time home buyers. And then they also trimmed their 5-year loan prime rate by more than expected 20 basis points down to 4.45%. And why does this matter? Because the lower mortgage rate for the new loans will help to, number one, lift mortgage loan growth on the margin, and that will actually help existing people as well, as they have a lower financing costs for existing mortgages. And this should really help them to have a little bit more disposable income that they could spend on consumption and help the overall growth picture in China as well. So we do think that we are quite unlikely to see even more dramatic cuts to the key policy rates because PBOC, the central bank in China, is still very wary of pumping too much credit into the economy. But we also think that China is very unlikely to hike its rates very soon because inflation is very well contained and it is necessary to provide a very accommodative environment, both on the fiscal as well as the monetary policy side, to help China to really return to growth. So we do think that the more supportive fiscal and monetary outlook will be really additive to the overall economic recovery picture in China. And then very quickly on the next page, looking at how that translates to earnings expectations, we do think if you can look on the top half of the page in the fifth column from the left-hand side, you can see that Asia ex-Japan earnings expectations are really low. It's at 1.5% for 2022. And given what we know so far about how China is really recovering, and we do expect it to recover quite quickly in the second half, as well as what we know about our ASEAN economies, which have really been continuing to reopen very aggressively, and how domestic recovery is actually also very well supported. We do think that earnings expectations are slightly negative, for this scenario that we have currently just gone through. And then if we look at the sector composition at the bottom half of the page, you can also see that Asia ex-Japan Equity Index is quite cyclically tilted. So we do know that Asia ex-Japan Financials is not the biggest market cap, but it is the biggest weight in terms of earnings contribution at around 30%. Industrials is also another big one at close to 10% of earnings. So, as central banks start to hike rates, not by normalizing their policy, not being like the Federal Reserve, that should really be positive for Asia ex-Japan Financials too. And because we do know that Asia ex-Japan region has not really seen the cyclical recovery that the developed world has experienced over the past year, and given that a lot of the index, like 40% or so, is tilted towards cyclicals, the overall index should be in a position to do well as the region really returns to recovery as well as growth. And then lastly, it's important to also look at valuations because while everything looks pretty rosy for now in Asia ex-Japan on a forward-looking basis, we need to know that we're not overpaying for these exposures as well. So on the top half of the page, you can see over here that valuations have derated pretty significantly, whether it's in the EM or whether it's in the developed markets. China is now under historical averages over the past 15 years. And, even things like the S&P 500 have derated much closer to historical averages as well. So we do think that for Asia ex-Japan, you do have this really good setup where you have relatively more attractive valuations, either on a standalone basis or versus developed market equities. You have this better growth backdrop. You have supportive monetary and fiscal policies. So it really does present quite an interesting opportunity here. And the way that investors can navigate this is also to focus on more quality companies that have visible and superior earnings revisions or return on equity that can help to mitigate some of the near-term uncertainty that we could face in the global landscape. So this is the end of the presentation, and I will pass it back to the host for the next segment if there are no questions.
Hi, Clara. Thank you very much for that. I'm not going to let you go first. I want to ask you some clarificatory questions, if you don't mind.
Yeah, of course.
Yeah. What caught me from all the things that you presented today, thank you very much, very comprehensive. What caught my eye is really the opportunity in Asia ex-Japan. It appears that even if the world, or maybe the biggest domestic developed markets are really going through some rough economic downturn or recession, we see opportunities in Asia ex-Japan. And as retail investors, you see our viewers are retail investors, and it may be difficult for them to access this market. What particular area, or is it, can we just get into, let's say, for example, a country fund or maybe an Asia X or Asia Pacific fund that so that we can catch this opportunity? Is that kind of a good idea as far as your views are concerned?
Yeah, so I think generally the backdrop that I've painted for the region is quite positive, and we're not overpaying for it, which is the most important part. But also my ending comments, I had mentioned that investors should really focus on quality companies as well, and without having to go through the pain of really looking through all of these companies' balance sheets and figuring out what their revenue trajectory looks like. You can actually rely on some form of active management to do that as well. So you do have more research analysts that are on the ground, that are familiar with all of these different workings of different companies across different countries in the region, because you do know that there's a lot of countries that make up even just ASEAN and not even Asia ex Japan as a whole. For them to really focus on picking out the best quality companies that can also give you exposure to the overall region's return to growth, if that makes sense. So a combination of getting exposure to the region, and then you can complement it by relying on some form of active management to complement that, or to kind of bolster the risk-adjusted return potential in this allocation. Right.
And given, just to follow up, given what's happening in the world again, you think this region, this Asia Pacific region, is more resilient, or even growth is even expected for the coming years? Is that right?
Yes, and a lot of that view is driven by two things. One is whatever that we're noticing in China right now, which is why I dedicated one whole section in this presentation to go through China and what's happening in the policy front and how they can actually return to a growth environment. The other thing is on ASEAN, because ASEAN has been in such a strict environment in terms of mobility for the past 2 years. And we have really ramped up our vaccination efforts and are now able to really reopen. So this combination of ASEAN's domestic recovery plus China returning to a more cyclical recovery overall, I think really helps the growth case for this region on at least over the next 12 to 18 months or so.
Great. Okay. Thank you very much.